Welcome back. So it's about 28 down on the index, and now the Nifty is somewhere around the 10,300 odd level. Mid-cap index, at least for now, the good news is that the slide is sort of not very, it doesn't have too much of momentum, so to speak. So it's kind of ambling along with the kind of cuts that we are looking at. The Nifty Bank is absolutely flat for the time being. But let's focus on a news story that's just coming through, and it's a cnbc TV 18 exclusive. Sources are telling us that the Steel and Mines Ministry is against reduction of export duty on iron ore. Anshu Sharma is joining in with all the details. Obviously, one can understand this because, they're the consumers, the domestic steel industry, so they wouldn't want more ore being exported. But what are the nitty-gritties, Anshu, and what can we expect?
That's right. So, Federation of Indian Mineral of Industry had written to Prime Minister's office seeking export duty reduction. Now, we are that Steel Ministry has written a letter to the Prime Minister's office. After discussion with Commerce Ministry and Mines Ministry, it has said that export of iron is about $62 per ton instead of steel products exported at $655 per ton. And mentioned that economic sense will be in exporting finished steel products in a way to boost Make in India, and only 21% of iron which are lying around as stockpile are of high grade. Now, to understand, 30% of export duty that FIMI was seeking is for the lower grade of iron ore, which are not utilized in India or in any Indian steel manufacturing company. So hence, the Steel Ministry has said that most of these iron ore stocks are lying around mines of Steel Authority of India and Tata Steel, and it doesn't make to reduce any export duty for high-grade iron ore which is produced in India. So we'll have to wait and watch out as to decision Prime Minister's office takes as to decision with regards to export curb is being taken by the Prime Minister's office. Back to you.
All right, Anshu, thanks a lot for that. Wait and watch as to where this decision goes, or what's the decision that the PMO takes. Thanks a lot for that. With that, we move on to the corporate story that is on our radar right now. Finolex Industries, that's the stock that we're watching out for. It's reacting positively in an otherwise weakish mid-cap market after Jefferies initiated coverage on the stock with a buy rating, target price placed at 690. To discuss this and the business outlook for the years ahead, we have Anil, Whabi, the director of the company, who joins in on the phone line. Thanks a lot, Anil, for joining in. One of the biggest bets that Jefferies has on Finolex is the fact that you are improving your product mix. You are going to premiumize. So if you could break up your revenue for us, how much of it comes from pipes, how much of it comes from plumbing and fittings, and how is this mix likely to change going forward? Break the pipe part up for us as well. How much of it is PVC, CPVC, etc.?
Good morning. See, traditionally, we have been strong in our supplies to agriculture for irrigation, for pipes and fittings. But in the past few years, we have tried to put our focus on non-agri sector also, which is infrastructure and housing. So that ratio in terms of volumes, it is almost 70% for irrigation and water supply, and 30% for plumbing and housing. So, and with more focus on housing and infrastructure, obviously the volume of the fittings also should inch up, because the requirement of fittings is more in housing sector.
So what's your target ratio in terms of sales, 70-30? Where does this mix go to? And if you could break up the margins for us as well in housing and fitting, in the plumbing and fitting business for housing, what are the margins you enjoy as against irrigation?
See, the margins in the pipe fitting sector that we normally get is about 8-9%, and it is obviously lower in the irrigation sector.
By how much?
70% being the major supply market for us. Obviously, it has a higher weight in the weighted average, but plumbing sector has a slightly higher margin. So, and within plumbing sector also, fittings enjoy better margins, CPVC enjoys better margin. So as we grow in these segments, the margins should improve.
So what will that mean, sir, for your total margins? I mean, as you go through some of these product mix changes in your overall offering, Because margins at the end of the last financial year had come down. I mean, the numbers that I have suggest that from around 21 odd %, you'd come down to about 17.5. Now, as you describe the individual segments, what will all of this mean on a blended basis, overall EBITDA margins?
See, overall EBITDA margins, if you look at, it depends on the performance of all the segments put together. Now, in pipes, last year was an exception because in our bid to gain on volumes, the realizations were a little lower. We grew in volume terms by about 20% last year, while the market had not grown so much. So the margins obviously were a little lower. But then in the current year, since the prices have been corrected, the margins should inch back to their normal levels.
What's the normal level, sir? So, I mean, will you go back to 20% plus? Again, I'm talking about the blended margin.
Now I'm coming to the second point.
Okay.
The other segment that we operate in is PVC segment, where there is some volatility. Last 2 years have been pretty good. Margins have been really good because the spread between EDC and PVC, which is normally tracked in the industry, has been exceptionally good because of the global conditions. But if you look at the close of Q1, compared to the spreads of last 2 years, the spreads have narrowed because of higher prices of inputs, which is mainly EDC, and lower prices of PVC.
All right. Mr. Whabi, before we let you go, just for this year and next year, if you could tell us your revenue and margin targets. FY19, what is your target? Last year you did about 2750 crores on the top line, and FY20.
See, what we target normally is the volume growth.
How much would that be?
It should be, see, past 10 years, if you see in the pipes and fitting segment, we have grown by about 12%. So we intend to grow at a similar level, 12 to 15% in the coming years also. And we feel with the right government thrust, the market also should grow in the similar fashion in agri.
And 3 to 4% price growth, can we expect that?
We want to do that. And double-digit growth we should be able to achieve.
All right. Thanks a lot, Mr. Whabi, for joining in and giving us all those details. Double-digit growth is what he's guiding for. 12 to 15% is the volume growth that they are targeting, with about 3 to 4% price growth. With that,